You already know it. I know it. I'm talking about the astronomical growth of Capitec Bank. Just 150 Rand when it listed would have made you a cool R250,000 today. That's 153,610% growth. But will lightning strike twice for Capitec? Today's episode, we're going to break down Capitec Bank. Is it too expensive or will it continue to climb without stopping? And by the end of the episode, we'll be buying shares live. So welcome back to Casual Cash. So I first bought Capitec in 2015 and sold it in 2020 for a good profit. But by the end of the episode, we'll be buying more shares here and in real time. All right. Well, the numbers of this company are amazing, but the tale of Capitec, how it started from nothing and became the biggest bank in South Africa, is an incredible story worth hearing. The Harvard Business Review tells of humble beginnings, where the big four banks dominated the banking industry. Then in 2000, a brand new Capitec Bank started its journey in the townships. These areas were too often forgotten and underserved by the bigger banks, and Capitec started to buy micro-lending businesses in these areas and converting them into bank branches. Ignored by the big four because they didn't see these areas as profitable, Capitec established itself with a simpler, cheaper, and more efficient business model. Once they established themselves in the rural areas in Johannesburg, they started entering other cities like Cape Town, Durban, and Pretoria. It set up branches near taxi ranks, and slowly but surely customers started leaving the big banks and moving over to the new Capitec. And as all other banks closed at 3:30 p.m. each day, Capitec stayed open up until 8 p.m. and Sundays, going the extra mile to provide service and a new way of banking to its customers. They even chose to hire retail workers rather than bank tellers from other banks because they focus on putting the customer first. But the biggest thing that set Capitec apart was its simplicity and its pricing. They even adopted the words of Leonardo da Vinci as their slogan, that simplicity is the ultimate sophistication. First of all, they had set a monthly fee of 5 Rand, miles below any other bank fees at the time. While the big four were charging percentages on transactions, Capitec had just one set low fee. As a customer, you could get confused with all the different offerings and products of FNB, Absa, Nedbank, and Standard Bank. Capitec had one account, one card, and one offering. That was it. It was incredibly simple, but done incredibly well. The founder and chairman, Rian Starson, has said, "Our strength has always been our focus." He implied that the company followed the hedgehog concept, which comes from an ancient Greek parable that states, "The fox knows many things, but the hedgehog knows one big thing." It means that many companies try to do too many things, that they lose any of their effectiveness in any one of those things. It says that the fox can try many things to catch a hedgehog. It sneaks, pounces, races, plays dead, tries devious tricks, but the hedgehog knows how to do one thing perfectly, and that is defend itself. That is exactly what we see with Capitec Bank. It produced one product. It focused on bettering banking and pricing for its customers, and, well, the rest is history. Today, Capitec is the country's largest digital bank, named the third strongest banking brand in the world. 840 branches later, with 13,500 employees and over 16 million clients, and growth that the big four could only dream of. Okay, so a pretty fascinating story. But here we are, as investors, looking at this growth and wondering if it's worth buying their shares now. If 600 Rand invested can turn into R1,000,000 in 20 years, what does the next 20 or 10 or 5 years look like, and should we be buying shares today? This is the exciting part for me. We're going to take a look at some quick numbers here. So first, I want to look at their track record. In the last 5 years, they're up about 160%. In 1 year, the share price has grown about 30%. In 6 months, 11%, still some good numbers. And in the last 1 month, it is down about 10%. There are a couple of reasons for this, including load shedding, consumer affordability, and inflation. But let's look at that dividend payment at 1.78%, which is about the same as it usually is, around 1 to 2%. Now, if you compare this to the other banks, it has a lower dividend. First Rand is about 4.5%, 4.6% for Absa, Standard Bank at 5.1%, and Nedbank is paying 5.4% dividends. but Capitec has outperformed all of them in share price growth, so there's a bit of give and take between growth and dividends. Lastly, let's take a look at the price to earnings ratio, which shows how expensive the share is compared to its earnings. The higher the number, the more expensive it is in terms of its earnings. ABSA is the technical cheapest share with a 7 price to earnings ratio. Nedbank is next with 9, Standard Bank is sitting at 10, and FirstRand the highest of the big four at 12. But if you think that's high, Capitec is sitting at over double that with 28. So the share price is at a 28 times multiple of its earnings. What that means is that future earnings are factored in. Basically, the market thinks they're going to grow more in the future and are willing to pay a higher price for it. Tesla, for example, has a price ratio of 128. So we know it's priced higher for the future, but will it reach that mark? A tip from me is to make sure you don't buy shares without reading the annual report first. It really tells so much. Let's see what Capitec's report says to us and whether we should buy it. Here, we're talking about an 84% increase in headline earnings, a 26% return on equity, a 14% growth in active clients, and a 17% increase in retail clients. But those are all on the income side. I want to know if their expenses have gone up along with that. For that, we're going to look at net income. Now, net income is income minus expenses, or you can maybe call it the profit. We're going to zoom in here and look at the last 5 years. So there was 12 billion net income in 2018, then 14 billion in 2019, 16 billion in 2020, down to 15 billion in 2021. COVID was hard for everyone. Then rocketing back up to 23.4 billion net income for this year of 2022. So if you look at these operating expenses, they are increasing slowly, but not as much as the income is increasing. That's a very good sign that they can continue to scale up and increase their profitability. On top of that, you may know that Capitec bought Mercantile Bank, a business bank, and are planning to rebrand it as Capitec Business. And maybe they can do with business banking what they did with consumer banking. I guess we'll have to see. The last thing is that they also paid an extra dividend this year of R1.50 per share on top of their normal dividend as a result of the BEE share scheme in February this year. Look, in my view, after looking through their books and reading their strategy for the future, unless they do something catastrophically wrong, I can't help but see their income and business grow in the future, especially as we expect interest rates to grow in the next 2 years. Right now, if you look at their price, you will see it's been battered by the markets, which is high inflation and unstable global trade. But as you saw in my last video, I bought an extra 500 Rand because I thought it was a good price. The question investors need to ask before investing is whether their high share price is too high for the earnings they may or may not get. For me, I chose to buy for the long term. So here we go. As you know, we use Easy Equities. Head over to Invest Now and Equities. Then search Capitec Bank, and we bought 2,000 Rand in shares for our portfolio, which we topped up last week with an extra 500 Rand. And that's it for today's episode. If you have Capitec shares or are thinking of it, you're welcome to subscribe to this channel to see how they do. And if you want to, you can like this video if you found the information helpful. But until then, I'll see you guys next time, as always, on Casual Cash. Cheers.